Welcome back to the Deep Dive. Today we're cutting through the noise and diving deep into the latest pulse of a significant regional property market.
That's right. We're working from a pretty comprehensive research report here.
Exactly. It's the Property Weekly Wrap, Week 26 Wrap, published July 1st, 2025, by Goldman Sachs Securities Company Limited.
A very recent snapshot, then.
It is. And our mission today, simple. We want to distill the most critical nuggets from this detailed analysis for you.
Give you that fast-track understanding without getting, bogged down in all the data overload.
Precisely. We're asking, is this market really turning a corner, or are we just seeing temporary blips in a larger, more complex story? Let's get right into it.
Okay.
So right from the start, the report makes one thing abundantly clear. Policy remains the bedrock of this market right now.
Absolutely central.
And we're not just talking minor tweaks here. We're seeing these concerted efforts from central authorities, big emphasis on integrating large-scale urban renewal with consumer trade-in programs.
And there's real money attached, isn't there?
There is. A notable RMB 138 billion quota still available just for the rest of this year. Plus, new allocations are coming in July and October.
And the monetary policy side.
Well, the Q2 Monetary Policy Committee meeting reaffirmed commitments to accelerate existing housing measures and also to intensify efforts revitalizing existing housing stock and land reserves.
So top-down, a very clear signal they want to re-energize demand. The intent is obvious.
Exactly. The scale and specificity really stand out.
But how does that intention translate on the ground? That's always the key question, right?
Right.
Looking at the immediate data, week 26, new home sales volume on average saw a significant jump, up 59% week over week.
That sounds impressive, a 59% jump.
It is in terms of weekly momentum. But, and this is a big but, it still leaves sales down 17% year over year.
Okay, so still digging out of a hole, essentially.
Precisely. It shows the scale of the challenge. The market's reacting, yes, but maybe not fundamentally shifted just yet. We did see particular strength in Tier 1 cities and the Yangtze River Delta region.
Suggesting where the policy impact might be hitting first.
Potentially, yes. Now, secondary transactions were, well, more modest, up only 3% week over week and actually down 3% year over year.
So a different story there.
A very different story. And here's a fascinating detail the report highlighted. A real divergence in sentiment.
Oh, between who?
Between agents and homeowners. Agents were expressing positive price appreciation expectations, feeling optimistic.
Okay.
But homeowners, not so much. They didn't share that same conviction. They were less bullish.
That disconnect is really intriguing. Agents are optimistic, owners are cautious. So, looking bigger picture now, first half of 2025 wrapped up.
Yeah.
What's the summary?
Well, the report lays it out clearly. Primary gross floor area GFA sold was down 2% year over year on a city average basis.
Okay.
Though interestingly, it was essentially flat year over year if you look at the aggregated volume.
Flat, okay. Still not great, but flat is better than down. What about
Okay.
secondary?
Secondary GFA sold painted a significantly different picture, much stronger. Up 18% year over year city average.
18%, that's substantial.
And even more robust, 19% year over year aggregated.
Wow. So the big takeaway here is this clear split, this divergence between primary and secondary markets.
Absolutely. Secondary showing surprising resilience. Maybe it's even a leading indicator of genuine demand.
It really is almost like two different markets moving at totally different speeds, isn't it?
It certainly looks that way, and that divergence, primary versus secondary, it's already striking. But what really caught my eye was how this played out in certain specific economic hubs.
Go on.
Well, connecting it to broader economic drivers, one of the report's key highlights is its assessment of global trade dynamics, specifically the impact on export-reliant cities.
Okay, so cities heavily tied to exports.
Exactly. And what's become increasingly clear is that these cities have shown notable strength, particularly in primary sales, compared to other cities.
Interesting. So their export performance is actually boosting their local primary property market.
It strongly suggests that. It seems those economic drivers are having a tangible, positive effect, creating a segment behaving quite differently. Honestly, when I first saw those numbers, it made me rethink some assumptions.
That's quite a statement. And it really hammers home that point. Not all local markets are moving together.
Yep.
So just how pronounced was that divergence? Let's dig into that.
Okay.
In week 26, primary volume in those most export-reliant cities, it absolutely surged, up an incredible 91% week over week.
91%. Wow.
91. Now compare that. Other cities saw respectable gains, sure, but recorded a much lower 36% week over week increase.
So that's a massive gap. What is that, a 56 percentage point spread?
Exactly, 56 points. Significantly wider than prior weeks, way above the average 4-point spread we'd seen since 2024.
That's remarkable. What about buyer interest, search activity?
Also interesting, new home search activity in these export cities was flat week over week. Stable demand. Whereas other cities actually saw a 1% decline in searches. It just underscores this unique, almost insulated position they have in the primary market right now.
That's a crucial distinction, though, because, when we shift focus to the secondary markets,
Does the picture change?
it does. It's much more aligned across different city types there. Export-oriented cities largely converged with their peers in secondary volume.
So similar performance.
Pretty much. Modest increases, around 1% week over week versus 2% elsewhere. Their secondary visitor traffic was slightly behind, actually down 1% week over week compared to a 1% increase elsewhere.
Okay.
But here's the key difference on the secondary side. Listing supply.
What about it?
It was much more restrained in those export cities, down 8% week over week.
Well, elsewhere.
Listings were up 7% week over week elsewhere.
So sellers in those export hubs are holding back more. Less urgency, perhaps.
That's what it suggests. Maybe more confidence, maybe just less pressure to sell. It creates a different supply-demand dynamic there compared to other areas, even in the secondary market.
It's a great reminder. Even within the same city type, primary and secondary markets can have totally different forces at play.
Exactly. It's not just the big national levers. It's these granular, local economic currents, too.
Real estate is always local, isn't it? So diving deeper again into week 26, that overall 59% primary market surge. It wasn't uniform across city tiers either, was it?
No, not at all. Tier 1 cities saw a strong 65% week-over-week increase, which sounds good, but they were still down 22% year-over-year.
Right. Still that negative year-over-year comparison.
Then Tier 2 cities mirrored the overall average, up 59% week-over-week, but they faced an even steeper year-over-year decline, down 27%.
Ouch. Okay, what about Tier 3?
This is where it gets particularly interesting, maybe even surprising. Tier 3 also rose 59% week-over-week.
Okay, same as the average.
They were up 9% year-over-year.
Up. Year-over-year. That's significant.
It really is. Shows some surprising resilience there, standing out from the higher tiers, still grappling with those year-over-year contractions.
Why do you think we're seeing that in Tier 3? Any clues in the report?
That's a good question. The report sort of hints at a few possibilities, lower price points maybe, making them more accessible, especially with policy stimuli.
Makes sense. First-time buyers, perhaps?
Could be. Or perhaps less speculative inventory overhang compared to higher tiers. Maybe even a catch-up effect as policies trickle down.
Okay. What about regionally? Any standouts?
Oh, absolutely. The Yangtze River Delta, the YRD, truly outperformed in week 26, an impressive 73% week-over-week increase.
73%.
And crucially, a 3% year-over-year gain.
So positive territory year-over-year like the Tier 3 cities.
Exactly, making it a clear outlier, likely driven by stronger regional economic activity there.
What about other regions?
The Pearl River Delta, PRD, was up a 28% week-over-week, so some recovery, but still down 14% year-over-year.
Okay.
More tempered.
Okay.
And central and western cities saw that 59% week-over-week gain, matching the overall market, but still 22% down year-over-year.
So it really paints this complex mosaic, doesn't it? Recovery mixed with ongoing challenges, varying hugely by segment and geography.
Precisely. A one-size-fits-all view just doesn't cut it. Each region, each tier, faces unique pressures and potentially unique opportunities.
Let's look year-to-date then for the first half of 2025. Primary GFA.
Sold in about 75 cities, averaged a 2% year-over-year decline.
Only 2%. That sounds better than some of those weekly numbers.
Well, yes, but it was also 24% down from 2023 levels. So the longer-term trend for primary sales still shows significant contraction, even if the year-over-year figure for H1 looks milder.
Got it. Context is key. And the secondary market year-to-date, still strong.
Very much so. Continues to tell a much stronger story, up 18% year-over-year in roughly 20 cities tracked.
Okay, consistent with the weekly picture.
And get this, up a remarkable 66% compared to the year-to-date figures from 2022.
66% versus 2022 YTD, that's huge.
It really highlights that stark contrast. Primary versus secondary performance year-to-date is a key takeaway. Maybe a flight to quality or just existing inventory being preferred.
What about those sentiment indicators, agents versus sellers?
Right, the Centilene Salesman Index, reflecting agents' views on prices, was slightly positive, so some optimism there on the front lines. But the Seller Asking Index, which tracks the average change in listed prices or maybe sellers' willingness to accept lower offers, that showed a small weekly decline.
Suggesting homeowners might still be adjusting expectations downwards, even if agents are feeling a bit better, still that disconnect.
Still that disconnect. Now, inventory levels are always critical, right? That supply-demand balance.
Absolutely.
What did week 26 show?
Total inventory balance saw a slight decrease, 0.2% week over week, a small positive sign.
Right.
And it was down 3.7% from the end of 2024.
Okay. Inventory slowly reducing.
More importantly, inventory months stood at 25.1.
How does that compare? It's an improvement from May's average of 26.2 months. So properties are moving slightly faster, or maybe supply isn't piling up quite as quickly, easing some pressure.
Is that across all tiers?
Yes, all tiers saw slight week-over-week declines. Tier 1 was down 7.8% from end 2024, Tier 2 down 1.6%, Tier 3 down 3.5%.
So these incremental improvements, while small, are worth watching. They could signal a gradual rebalancing.
Exactly. Potentially setting the stage for future price stabilization if the trend continues.
Okay, but what about future supply? New homes coming online.
Well, the analysis there indicates ongoing declines. This could really impact the market down the line, maybe creating scarcity.
How so?
The property completion tracker implies a mid to high teens level year-over-year decline in completions for June.
So fewer homes actually finished.
Right. And the projection is for a 10% year-over-year decline for the full year 2025.
And new starts, beginning construction.
Also expected to see a high teens year-over-year decline in June. That's based on things like land sales, cement shipment trends, so continued reduction in new construction activity.
Okay. Less future supply coming through the pipeline. But you mentioned some positive peripheral indicators.
Yes, a couple of glimmers suggesting consumer activity might be stirring, which offers a bit of a counterpoint. Home appliance sales, for instance.
Often a proxy for home buying and renovation.
Exactly. They're likely to show year-over-year improvement in June, and Beek's gross transaction value, GTV, for new and existing homes, that's estimated to have improved 4% year-over-year in Q2 2025.
Okay, so suggesting consumer activity, while maybe not booming, is showing some signs of life.
Right. It offers a counterpoint to just focusing on the reduced supply narrative.
Which brings us, logically, to developer valuations. How are they looking?
Well, the report uses a pretty strong phrase. It describes them as being at a downturn trough.
A trough. That implies the bottom, or close to it.
That's the implication. Over week 26, offshore developers saw share prices gain 2% week over week, basically matching the broader MSCI index. Jinnow did better, up 8%.
And onshore.
Onshore developers also averaged a 2% week over week gain, aligning with the CSI 300. Gemdale was up 4%.
So modest gains, but occurring against what backdrop?
Against a backdrop of deeply, deeply discounted valuations. The core insight here is that the market seems to have priced in, well, almost a worst-case scenario for many developers.
Leaving potential upside if things just stabilize, let alone recover strongly.
That's the idea. There could be significant upside if even a modest recovery takes hold.
Let's put some numbers on those valuations for you, the investor. Give us some stark perspective.
Please do.
Offshore coverage now trades at an average 38% discount to end 2025 estimated net asset value, NAV.
38% discount. That's substantial.
And maybe even more telling, a remarkably low 0.5 times 2025 estimated price to book, PB.
0.5 PB.
These numbers aren't just cheap. They are incredibly close to, or even lower than, historical trough levels we saw in major downturns like 2008, 2011, 2014.
So comparing to the global financial crisis period, for instance.
Exactly. In the second half of 2008, offshore developers traded at a 39% NAV discount, similar to now, but at 0.7 times PB.
And now it's 0.5x PB.
Precisely. Notably lower. Think about that for a second. The market is pricing these companies as if things are worse now than during the GFC for book value multiples.
That really highlights the extreme caution, doesn't it?
It does. And onshore coverage shows a similar story. 24% discount to end 2025 NAV, 0.5 times PB. Also comparing very favorably, or perhaps worryingly, depending on your view, to those previous troughs.
It definitely highlights the market's current pricing of risk, or maybe the perceived lack of potential in the sector right now.
Deep, deep discounts relative to history.
Even relative to periods characterized by significant downturns and huge uncertainty, it really implies a substantial amount of negative sentiment, future challenges. It's already baked into the price.
Which raises those big questions, doesn't it? Where is the true inflection point?
Exactly. Do these valuations present a compelling long-term opportunity for investors willing to stomach the volatility? Or is there still further downside despite how low they look historically?
It's a truly complex risk-reward calculation right now.
No easy answers.
So, after unpacking all this data, some critical questions really jump out. And I want you, our listener, to maybe consider them alongside us as you think about your own strategy.
Bad idea.
First, we've seen these central level policy commitments, right? Big efforts. But we've also seen mixed market data, strong week over week primary sales, yes, but cautious homeowners, persistent year-over-year declines in some key segments. So how effectively are these existing measures actually translating into a sustained market recovery?
And flowing from that, what specific data points would you be watching most closely for a clear signal of inflection? Is there one magic number?
For me, I keep coming back to that year-over-year secondary market volume. That feels like genuine end-user demand starting to solidify. What about you?
I agree that's crucial. I'd also watch the inventory months figure closely. If that continues to tick down consistently, it signals a healthier supply-demand balance forming.
Okay. Second big question area. That notable outperformance in primary fails for export-reliant cities.
Right, indicating those unique underlying economic drivers.
What does this divergence really tell us about the segmentation of the property market? Is this a sustainable trend, you think, linked to trade resilience, or is it more of a temporary anomaly?
That's a tough one. My initial thought is if global trade holds up, these cities could remain relative bright spots. But it feels like a tightrope walk, highly dependent on those external factors staying positive. It highlights market fragmentation.
It does. Okay, finally, let's talk developers again. Valuations described as being at downturn troughs, completions and new starts declining.
A challenging operational picture, even if valuations look cheap.
So what does this combination imply for investor appetite? And for the potential for either genuine recovery or maybe further consolidation within the sector? Where do you see the highest risk now, and where might the opportunity actually lie in this complex environment?
Well, the risk still feels tied to the broader economic trajectory and policy execution effectiveness. If the economy slows further or policies don't gain traction, even cheap valuations might not be enough support.
But the opportunity.
Paradoxically, it might be in those deeply discounted valuations, as you said. If you have a longer-term view and believe in an eventual cyclical recovery and can pick the survivors, maybe also in the potential for consolidation beneficiaries.
Fascinating stuff. This has been an incredibly insightful deep dive. It really reveals a market that's far more nuanced than the simple headlines might suggest.
Absolutely.
We've seen glimmers of hope, maybe particularly with valuations hitting those troughs, but it still feels like a very complex, perhaps even fragile recovery picture overall.
I agree. The data clearly shows that while some segments are reacting positively, whether it's to policy or specific economic drivers like exports, the overall picture demands a really nuanced understanding.
It's definitely not monolithic.
Far from it. And that interplay between the macro policy and the micro market behavior, that remains absolutely key to watch.
And that complexity makes it all the more critical for you, our listeners, to understand these underlying currents. This report gives you plenty to chew on, hopefully allowing you to connect the dots and anticipate where the market might head next.
Keep these insights in mind.
Indeed. Keep them in mind as you navigate the investment landscape. Thank you so much for joining us for this deep dive. We'll be back next time with more crucial intelligence.